There is a concept, an idea so simple and yet so profound that it forms the bedrock of one of the greatest fortunes ever assembled. It's not about complex algorithms or high-frequency trading or betting on the next speculative technological fantasy. It is about something far more ancient, far more durable. It's about owning the bridge. Imagine a small, prosperous town nestled in a valley, bisected by a deep, impassable river. For centuries, the only way to get from one side to the other, from the homes to the factories, from the farms to the market, was to cross a single, sturdy, stone bridge. The family that owned that bridge didn't have to invent a new product every year. They didn't have to worry about changing fashions or new competitors. All they had to do was maintain the bridge and collect a small toll from every single person, every cart, every piece of commerce that needed to cross. Their revenue was predictable, it was recurring, and it was almost completely insulated from the chaos of the world around them. This is the mental model at the very heart of Warren Buffett's investment philosophy. He isn't just buying stocks, he is buying pieces of these economic toll bridges. He is searching for businesses that own an essential service, a piece of infrastructure so vital that the economy simply cannot function without it. These are the businesses that allow him, and the investors who follow his logic, to sleep well at night, knowing that no matter what the headlines scream tomorrow, the toll will still be collected. The costly mistake this approach prevents is perhaps the most common and most devastating in all of investing. The permanent loss of capital that comes from buying into a business whose product can be, and will be, made obsolete. The world is littered with the corpses of companies that were once giants, companies that made products everyone thought were indispensable, only to be wiped out by a tidal wave of innovation they never saw coming. The toll bridge investor sidesteps this graveyard entirely. The financial transformation that this single idea offers is the ability to build a portfolio not of flickering lottery tickets, but of durable, resilient fortresses. Companies with highly predictable, inflation-resistant cash flows that can compound wealth not just for years but for generations. Today, we are going to deconstruct this master key to long-term investing. We will learn the anatomy of a true economic toll bridge, how to spot them, how to differentiate them from the dangerous pretenders, and how to build your own portfolio of these unbeatable businesses. This is the blueprint for creating a financial bedrock, for insulating your wealth from the chaos of creative destruction, and for harnessing the unstoppable power of owning the indispensable. Our first step is to truly understand the architecture of this idea. What, precisely, makes a business an economic toll bridge? It goes far beyond just a physical structure. It is a specific set of characteristics that create a nearly unassailable competitive advantage. We must dissect its anatomy to understand its power. To do that, we need to go back in time, not to a railroad or a pipeline, but to a seemingly ordinary business that Buffett saw as one of the most perfect toll bridges he had ever encountered: a newspaper. The story begins in 1977. Warren Buffett and Berkshire Hathaway set their sights on the Buffalo Evening News. On the surface, it was just a local paper in an upstate New York City. But Buffett saw something much deeper. He saw a local information monopoly, an information toll bridge that every citizen and business in Buffalo had to cross. At the time, Buffalo had two major newspapers: the morning paper, the Courier Express, and the dominant evening paper, the Buffalo Evening News. Buffett's target, the Evening News, had a massive circulation advantage. He understood a critical dynamic of the newspaper business in that era. In a two-paper town, the one with the larger circulation gets the lion's share of the advertising revenue. Advertisers want to reach the most eyeballs, so they flock to the leader. This creates a virtuous cycle. The leading paper gets more ad revenue, which allows it to invest in better journalism, better features, and better printing, which in turn attracts more readers, further solidifying its lead. The weaker paper is trapped in a death spiral. Buffett saw that the Buffalo Evening News was on the positive side of that equation. He agreed to buy the paper for $32.5 million, but there was a catch. To protect its evening dominance, the Buffalo Evening News had never published a Sunday edition, ceding that lucrative ground to the Courier Express. Buffett knew that to truly solidify the moat, he had to control the entire week. He announced his intention to launch a Sunday edition of the Buffalo News. This was a declaration of war. The owner of the Courier Express, a man with deep pockets, saw this as an existential threat and immediately launched an antitrust lawsuit, claiming Buffett was trying to create a monopoly. Simultaneously, he prepared to fight a bloody circulation war. The battle was ferocious. For the next several years, the two papers bled money, spending millions on promotion, cutting subscription prices, and fighting for every last reader and advertiser. It was a brutal test of will and financial endurance. Many observers thought Buffett had made a colossal error, wading into a war of attrition that could destroy the value of his new purchase. But Buffett understood the nature of his toll bridge. He knew that if he could withstand the initial pain, the prize was total market dominance. He had the financial backing of Berkshire Hathaway, a fortress of capital, while his competitor was a standalone entity. Eventually, the economic reality became undeniable. The Courier Express, caught in the death spiral, was losing millions of dollars a year with no end in sight. In 1982, it finally surrendered, shutting its doors forever. Suddenly, Buffett's Buffalo News was the only game in town. The war was over, and the toll bridge was complete. Overnight, the economics of the business were transformed. With no competitor, the Buffalo News had immense pricing power. Local department stores, car dealerships, real estate agents, anyone who needed to reach the population of Buffalo, had no other choice. They had to advertise in Buffett's paper. He could raise ad rates year after year, and the customers had to pay. The paper became a gusher of cash flow, a machine that minted money with very little need for additional capital investment. It was the perfect toll bridge. It owned the flow of essential local information, and everyone had to pay the toll to get their message across. This anecdote reveals the core of the idea. A toll bridge is a business that controls something essential, faces little to no meaningful competition, and as a result, possesses the power to set its own prices. This entire strategy works because it elegantly exploits deeply ingrained patterns of human psychology. The power of an economic toll bridge is rooted in two fundamental cognitive biases: the scarcity heuristic and the status quo bias. The scarcity heuristic is a mental shortcut our brains use to assign value. We instinctively believe that if something is rare or difficult to obtain, it must be more valuable. A true economic toll bridge is the ultimate scarce asset. There is only one main railroad line connecting two major cities. There is only one dominant credit card network. There is only one town newspaper. This structural scarcity signals immense value not just to investors but to the customers of the business itself. Customers understand, even subconsciously, that they have no other viable option. This lack of choice fundamentally alters their behavior. They become price takers, not price setters. Their focus shifts from "how can I get a better deal" to "I need this service to function, so I must pay the price." This is the psychological foundation of pricing power. The second principle, status quo bias, is our inherent preference for the current state of affairs. Change is cognitively expensive. It requires effort, research, and accepting new risks. Because of this, we tend to stick with what we know, even if a slightly better alternative becomes available. A toll bridge business is the ultimate beneficiary of this bias. Once a utility, a railroad, a pipeline, or a software ecosystem becomes the established standard, the inertia required to displace it is monumental. Think about the keyboard you're typing on. The QWERTY layout is objectively inefficient, designed intentionally to slow typists down on old mechanical typewriters to prevent jams. Far superior layouts exist, yet the entire world runs on QWERTY. The cost of retraining hundreds of millions of people is so astronomically high that the inefficient status quo remains locked in place. This is the power of an established standard. A business that becomes the QWERTY of its industry has built a moat fortified by the collective laziness of the human brain. Customers won't switch because it's too much of a hassle. Competitors can't gain a foothold because they can't overcome the mountain of collective habit. This is why a business that provides an essential service and has been around for decades becomes more powerful over time. Its position becomes ingrained in the culture and workflow of its customers, making the idea of switching not just costly, but almost unthinkable. Buffett understands that a business that harnesses both scarcity and the powerful force of human inertia has created a competitive advantage that is nearly impossible to break. So how do we translate this powerful theory into a practical tool for our own investment decisions? We can create a mental model, a blueprint called the 5 questions of indispensability. This is a checklist you can run any potential investment through to see if it has the genetic makeup of a true economic toll bridge. The first question is this service or product a need or a want for its customers? A want is discretionary. People buy it when they feel prosperous and cut back when times are tough. A need is non-negotiable. You pay your electricity bill whether you get a raise or not. A railroad must ship grain whether the stock market is up or down. A true toll bridge serves a fundamental recurring need. The demand for its service is deeply inelastic, meaning it doesn't change much even when the price goes up or the economy goes down. The second question, if this company disappeared overnight, would its customers be significantly and immediately harmed? If Google disappeared, the world would be thrown into chaos. If a trendy fashion brand disappears, people simply buy another brand. The more pain and disruption a company's theoretical disappearance would cause, the more indispensable it is, and the more likely it is to be a toll bridge. This question cuts right to the heart of its importance in the economic ecosystem. The third question is the replication test. How difficult, costly, and time-consuming would it be to replicate this company's service from scratch? To compete with a railroad like BNSF, you would need hundreds of billions of dollars, decades of time, and the political power to acquire rights of way across thousands of miles of private land. It is practically impossible. To compete with a new social media app, you need a few clever coders and a marketing budget. The higher the barrier to entry, be it regulatory, capital-intensive, or based on a network effect, the wider and deeper the moat. The fourth question is about pricing power. Does the company have a demonstrated history of raising prices consistently without losing significant business? Look at the company's financial history. Does its revenue per user or per unit steadily climb over time? A company in a brutal competitive environment has to cut prices to win business. A toll bridge can and does increase its toll every year, like clockwork. This is the single most important indicator of a durable competitive advantage. The final, fifth question. Does this business benefit from being the established standard? This is the test for network effects and status quo bias. Does the service become more valuable as more people use it, like a credit card network or a social media platform? Is the service so deeply embedded in a customer's workflow that switching would be a nightmare, like with mission-critical enterprise software? A business that can answer a resounding yes to this question has a self-reinforcing moat that grows stronger with each passing day. By systematically applying these 5 questions, you can begin to separate the truly indispensable businesses from the crowd of pretenders. It provides a structured way to think about the quality and durability of a company's competitive advantage, which is the first and most critical step in building a portfolio for long-term investing. To fully appreciate the wisdom of this approach, we must spend time examining its opposite. We must walk the path of the 99%, the path littered with financial ruin, to understand the mistakes the toll bridge strategy helps us avoid. The antithesis of owning a toll bridge is chasing growth in hyper-competitive, low-barrier-to-entry industries. This is the siren song that lures countless investors to their doom. Think of the restaurant industry. Opening a restaurant is relatively easy. It requires some capital but not an insurmountable amount. The result is a brutal landscape. Every neighborhood has dozens of restaurants competing for the same customers on price, quality, and ambiance. A new hot restaurant opens, and it's popular for a year. Then another one opens down the street, and the crowd moves on. The failure rate is astronomical. There is no pricing power, no customer loyalty, no durable advantage. It is a constant, exhausting battle for survival. Or consider the world of consumer tech apps. For every massive success, there are thousands of forgotten failures. An app for photo sharing, for social networking, for to-do lists. The barrier to entry is just a few lines of code. Competition is global and instantaneous. A user might love an app for a few months, but their loyalty is wafer-thin. The moment a slightly better, cheaper, or trendier alternative appears, they switch without a second thought. These businesses are not toll bridges. They are treadmills in a burning building. They must run faster and faster, spending enormous sums on marketing and development, just to stay in the same place. The dot-com bubble of the late 1990s was the ultimate expression of this folly. Investors poured billions of dollars into companies that had no revenue, no profits, and most importantly, no moat. They had a good story, a .com at the end of their name, and a vague promise to change the world. The focus was entirely on growth at any cost, growth in eyeballs, growth in users, growth in mind share. Little to no thought was given to whether these businesses could ever build a defensible position that would allow them to generate sustainable profits. Companies like Pets.com or Webvan were trying to compete in industries like pet supplies and groceries, industries with razor-thin margins and entrenched physical competitors. They had no unique advantage other than a website. When the bubble burst, investors who had bought into the story without analyzing the business model suffered a permanent and catastrophic loss of capital. This is the key danger the toll bridge model avoids. It's not just about losing money in a market downturn. It's about investing in a business that is fundamentally flawed and destined to go to zero. The path of the 99% is paved with these exciting, fast-growing, but ultimately fragile businesses. The path of the toll bridge investor is slower, less exciting, but leads to a destination of durable wealth. The difference between these two paths isn't just philosophical. It's starkly visible on the financial statements of a company. The direct financial connection between owning a toll bridge and superior returns can be seen by focusing on two key metrics: gross margins and return on tangible capital employed, or ROTCE. Gross margin is calculated by taking a company's revenue and subtracting the cost of goods sold. It tells you how much profit the company makes on each dollar of sales before accounting for overhead and other expenses. A company in a fiercely competitive industry will have low gross margins. To win a sale, it has to lower its price, so its margin on that sale is thin. A restaurant might have a gross margin of 10 or 15%. A car manufacturer might be similar. But a true toll bridge business, because of its immense pricing power, will have exceptionally high and stable gross margins. Think of a software company that owns the industry standard. Once the software is written, the cost of selling one more copy is virtually zero. Its gross margins can be 80 or 90%. A credit rating agency like Moody's has a legally mandated monopoly on certain ratings. Their cost of goods sold is primarily the salaries of their analysts. The value of their rating, however, is immense. This allows them to command high prices and generate fantastically high gross margins. These high margins are a direct financial signal of a strong competitive advantage. The second metric, return on tangible capital employed, tells you how efficiently a company is using its physical assets, its factories, equipment, and infrastructure to generate profits. Many businesses need to constantly reinvest huge sums of money just to stay competitive. An airline has to constantly buy new, expensive planes. A semiconductor company has to build multi-billion-dollar fabrication plants. These businesses might be profitable, but they are capital-intensive. A great toll bridge, on the other hand, can generate enormous profits without needing to constantly reinvest. Once the bridge is built, it just needs to be maintained. Buffett's Buffalo News, once it achieved dominance, didn't need to buy a lot of new printing presses. It just collected the ad revenue. See's Candies doesn't need to build massive new factories every year. This results in a very high ROTCE. The business produces a gusher of free cash flow, cash that doesn't need to be plowed back into the business just to keep the lights on. This is the holy grail for a long-term investor. This excess cash can be used to pay dividends, buy back its own stock, increasing your ownership stake, or acquire other businesses. This is how the engine of wealth building and compounding truly ignites. When you find a business with high and stable gross margins combined with a high return on tangible capital, you have found the financial footprint of an economic toll bridge. Now that we understand the anatomy of the toll bridge, let's examine one of the grandest examples in modern history: Warren Buffett's masterstroke acquisition of the Burlington Northern Santa Fe Railroad, or BNSF. This is the story of a literal, physical toll bridge on an epic scale, and it perfectly illustrates the power of owning essential infrastructure. The year was 2009. The world was still reeling from the greatest financial crisis since the Great Depression. Fear was everywhere. The stock market had been cut in half. The consensus view was that the American economy was in a permanent state of decline. It was in this environment of maximum pessimism that Warren Buffett announced Berkshire Hathaway would be acquiring the entirety of BNSF Railroad for a staggering $44 billion. It was the largest acquisition in Berkshire's history. Wall Street was stunned. Why, at a time of such economic uncertainty, would Buffett make such a massive leveraged bet on something as old-fashioned and capital-intensive as a railroad? In a letter to shareholders, Buffett called the deal an, quote, all-in wager on the economic future of the United States. He wasn't betting on the next quarter's earnings or the next year's GDP. He was looking out over the next century and seeing an unchangeable reality. BNSF is not just a company, it is a vital artery of the American economy. It operates over 500 miles of track, stretching from the ports of the West Coast to the industrial heartland and the population centers of the East. It is a continent-spanning toll bridge for physical goods, everything from the coal that powers electricity plants, to the grain that feeds the world, to the thousands of shipping containers filled with consumer goods that arrive from Asia. It all moves on these steel rails. Buffett saw that while the nature of the goods might change over time, the fundamental need to move massive quantities of physical stuff across the vast distances of North America would not. He saw an irreplaceable asset. Think about what it would take to build a competitor to BNSF. You would need to acquire a continuous corridor of land 500 miles long, navigating a labyrinth of private property rights, environmental regulations, and local politics. It would take decades, and the cost would be in the trillions of dollars. It is, for all intents and purposes, impossible. BNSF and its main competitor, Union Pacific, form a duopoly on rail transport in the western United States. For many of their customers, shipping heavy bulk commodities over long distances, there is no viable alternative. You cannot move 1 million tons of coal by truck. The cost would be prohibitive. This gives the railroad immense pricing power. They can raise their rates by a few percent each year, tracking or slightly exceeding inflation, and their customers have no choice but to pay. It is the definition of a durable, inflation-proofed business model. Buffett's purchase of BNSF was a masterclass in long-term, strategic thinking, a perfect execution of the toll bridge philosophy. The decision to buy BNSF in the dark days of 2009 was only possible because Buffett was able to override two of the most powerful and destructive psychological biases that plague investors: loss aversion and myopic thinking. Loss aversion is the well-documented phenomenon that for humans, the psychological pain of losing is about twice as powerful as the pleasure of gaining. A $1,000 loss feels as bad as a $2,000 gain feels good. During a market crash, this instinct goes into overdrive. Investors who have seen their portfolios decline by 30, 40, or 50% are not thinking rationally about future returns. They are consumed by the pain of their losses and are terrified of losing more. Their primary impulse is to sell everything, to go to cash, to stop the bleeding. They will sell perfectly good assets at ridiculously low prices simply to avoid the emotional pain of seeing their value fall even further. This is precisely what was happening in 2009. The market was gripped by a collective panic attack, driven by extreme loss aversion. While everyone else was selling, Buffett was buying. He was able to emotionally detach from the short-term price action and focus on the long-term intrinsic value of the business. The second bias at play is myopic thinking, or short-sightedness. Our brains are wired to prioritize immediate threats and rewards over distant ones. In 2009, the immediate threat was a global economic collapse. The daily news was a fire hose of negativity about bank failures, unemployment, and recession. Most investors couldn't see past the next headline. Their analytical time frame had shrunk from years or decades to days or even hours. They were trying to navigate a hurricane by looking at the waves crashing over the bow. Buffett, in contrast, was standing in the crow's nest, looking at the horizon. He understood that financial crises, even severe ones, are temporary storms, but a nation's need for fundamental infrastructure is permanent. He was playing a different game, on a different timescale. He was able to look past the immediate, terrifying myopia of the market and see the 100-year reality of BNSF's position. He famously said that he was betting on America. This wasn't just a patriotic platitude. It was a calculated investment decision based on the psychological principle that the market's short-term fears often create incredible opportunities for those who can maintain a long-term perspective. By overcoming the twin demons of loss aversion and myopia, he was able to acquire a crown jewel asset for his portfolio strategy at a price that reflected temporary fear, not permanent reality. This anecdote provides us with the raw material for another powerful mental model, a practical blueprint we can use to identify these kinds of physical, permanent assets. Let's call it the permanent asset litmus test. It consists of 4 distinct tests. The first is to identify the core economic function. You must ask, what fundamental, almost primal economic need does this asset serve? You must strip away all the jargon and financial metrics and get down to the bedrock purpose. For BNSF, the core function is moving massive quantities of physical goods over vast distances. For a power utility, it's generating and distributing electrons. For a pipeline, it's transporting energy from where it's produced to where it's consumed. The function should be so simple and essential that you could explain it to a child. If you can't, the business might be too complex or transient. The second is the replication test. This is a thought experiment. You must ask, what would it cost in today's dollars, and how long would it take to build a direct competitor to this business from a standing start? Be brutally realistic. Factor in not just the cost of materials and labor, but the immense hurdles of regulation, land acquisition, and political opposition. For BNSF, the answer is trillions of dollars, and it is effectively impossible. For a company that owns a unique patent, the answer is the life of the patent. For a company with a popular brand, the answer is billions in marketing and decades of consistent execution. The higher the cost and time of replication, the more permanent the asset. The third test is the century test. Ask yourself, can I, with a high degree of confidence, predict that the core economic function this asset serves will still be needed by society in 50 or even 100 years? People will still need electricity. People will still need to transport goods. People will still need water. People will likely not need the same smartphone model, the same social media app, or the same fashion brand. This test forces you to differentiate between a durable, long-term human need and a temporary technological solution. It's a powerful filter against the siren song of disruptive innovation that often leads to permanent capital loss. Finally, there is the pricing power test. This connects the asset to its financial performance. Ask, how does the cost of this company's service compare to the total value of the goods or services it enables? For BNSF, the cost of shipping a container of iPhones from a port to a distribution center might be a few $100s. The value of the iPhones in that container is hundreds of thousands of dollars. The shipping cost is a rounding error. This vast difference between the cost of the toll and the value of the commerce it enables is the source of all pricing power. It allows the railroad to consistently raise its prices without destroying demand. A business that passes all 4 of these tests, a simple core function, Impossible replication, a century of relevance, and a tiny cost relative to the value it provides, is a true permanent asset. It's the kind of blue-chip investing opportunity that forms the foundation of generational wealth. To truly grasp the genius of buying a BNSF, it's essential to study its polar opposite, the business that looks similar on the surface but is, in reality, a financial black hole. The perfect antithesis to a railroad is an airline. This is the path of the 99% in the world of capital-intensive businesses, and it is a cautionary tale for every investor. At first glance, airlines and railroads seem to have a lot in common. Both are in the transportation business. Both require huge amounts of capital to buy their primary assets: planes for airlines, locomotives, and track for railroads. Both are essential to the modern economy. But this is where the similarities end, and a deep, dark chasm opens up between a wonderful business and a terrible one. The fatal flaw of the airline industry is the complete and utter lack of a competitive moat. While it's impossible to replicate BNSF's track network, it's relatively easy for a new company to lease a few airplanes and start flying a popular route, for example from New York to Chicago. This means the industry is in a perpetual state of brutal suicidal price competition. For the customer, the service is a commodity. Most people do not care if they fly on American, United, or Delta. They care about two things: schedule and price. They will almost always choose the cheapest flight that fits their schedule. This forces the airlines to constantly undercut each other on price, driving profit margins down to near zero or often into negative territory. They have absolutely no pricing power. In fact, they have negative pricing power. The internet and booking sites have made it easier than ever for consumers to compare fares, increasing the competitive pressure. Furthermore, airlines are a capital sinkhole. A new Boeing 737 costs over $100 million. The airlines have to constantly buy new planes to stay competitive and meet safety standards. But unlike a railroad's track, which is a unique and permanent asset, a plane is just a commodity. It doesn't give the airline any durable advantage. It's just a ticket to play in a terrible game. Buffett himself has famously commented on the disastrous economics of the airline industry. He once joked that if a capitalist had been a Kitty Hawk, he should have shot Orville right down. He has pointed out that from the dawn of aviation until the early 2000s, the net cumulative profit of the entire United States airline industry was negative. Trillions of dollars of investor capital had been poured into the industry, and it had all been destroyed by relentless competition, high fixed costs, powerful labor unions, and sensitivity to fuel prices. Investors who are drawn to airlines because they are a vital industry are making a classic mistake. They are confusing the importance of an industry with the profitability of its businesses. The airline industry is a perfect example of a capital-intensive business without a moat. It is the anti-BNSF. It is a machine designed to destroy shareholder wealth, not create it, a stark warning for anyone trying to practice long-term investing. The financial contrast between a railroad and an airline is as stark as night and day, and it can be clearly seen by examining capital expenditures, or CapEx, and free cash flow. CapEx is the money a company spends on physical assets. Free cash flow is the cash left over after all expenses, including CapEx, have been paid. This is the cash that is available to be returned to the owners of the business, the shareholders. A business like an airline has enormous and unrelenting CapEx requirements. They are constantly buying new planes. This spending is not optional. If they don't keep their fleet modern, they will fall behind competitors and face higher maintenance costs. A large portion of this is what can be called growth CapEx. But it's a deceptive term. They are spending billions, not to expand into new, profitable territory, but just to maintain their position on the competitive treadmill. This massive CapEx devours their operating profits, leaving very little, if any, free cash flow for shareholders. Now consider BNSF. It also has significant CapEx. It must spend billions every year to maintain its 32,500 miles of track, its bridges, its tunnels, and its fleet of locomotives. This is maintenance CapEx. It is the cost of keeping the toll bridge in perfect working order. But here is the critical difference. This spending is not to fend off competitors. It is to maintain a dominant, irreplaceable asset. Because it operates in a duopoly and has immense pricing power, its revenues are vast and predictable. After it pays for its operating expenses and its maintenance capex, what's left is a tremendous amount of free cash flow. This is a river of cash that flows directly to its owner, Berkshire Hathaway. In a typical year, BNSF can generate more than $5 billion in free cash flow. This is pure profit that Berkshire can then use to invest in other businesses, buy back its own shares, or simply hold as a store of value. It is the ultimate source of passive income at a corporate scale. This is the tangible financial result of owning a toll bridge. You spend what is necessary to maintain your unassailable position, and the rest is yours to keep. A capital-intensive business without a moat, like an airline, is a bucket with a hole in it. The more money you pour in, the more leaks out in the form of brutal competition and necessary but unproductive spending. A capital-intensive business with a moat, like BNSF, is a fortress with a deep, productive well inside. It requires upkeep, but it provides a steady, reliable, and growing supply of the one thing that matters most to an investor: cash. This distinction is at the very heart of successful portfolio strategy. The concept of the toll bridge is not confined to the world of physical steel and concrete. In the modern economy, some of the most powerful and lucrative toll bridges are entirely digital. They are the invisible infrastructure, the networks, payments, and data systems that form the rails of modern commerce and finance. To understand this evolution, we must turn to another one of Buffett's most brilliant and long-standing investments: American Express. The story that cemented his belief in this digital toll booth took place long ago, in 1963, and it is known as the salad oil scandal. A company called Allied Crude Vegetable Oil, run by a swindler named Tino DeAngelis, was a major customer of a subsidiary of American Express that was in the business of warehousing. DeAngelis used warehouse receipts from Amex, certifying that he had vast quantities of salad oil stored in tanks in New Jersey, as collateral to get huge loans from banks. The problem was, the tanks were mostly filled with seawater. When the fraud was discovered, Allied Crude went bankrupt, and the banks that had loaned money against the worthless receipts turned to American Express to make them whole. Wall Street panicked. They assumed American Express would be on the hook for losses that could potentially bankrupt the entire company. The stock price was decimated, falling by over 50%. The consensus was that Amex was doomed. But Warren Buffett, then a young, little-known fund manager, was skeptical. He decided to do his own on-the-ground research, what he called scuttlebutt. He flew to New York and started visiting restaurants, talking to waiters and cashiers. He went to banks and spoke with tellers. He was asking one simple question: are people still using American Express cards and traveler's checks? The answer he got, over and over, was a resounding yes. He realized that the market was making a classic mistake. It was confusing a problem in one small, isolated part of the business, the warehousing subsidiary, with the core, crown jewel business itself. The core business was the payments network. It was the powerful brand in the minds of affluent consumers and the trusted acceptance mark in the windows of merchants. This was a toll bridge built not on physical assets, but on a psychological network of trust and habit. The salad oil scandal, as damaging as it was to one division, had not dented the real source of the company's value one bit. Convinced that the market was gripped by an irrational fear, Buffett invested a staggering 40% of his investment partnership's capital into American Express stock. Within a few years, the company resolved the scandal, the market realized its error, and the stock price soared. Buffett made a fortune for his partners. This anecdote is a timeless lesson in the resilience of a digital toll bridge. The value is not in a warehouse or a factory, it is in the network itself, and a powerful network is one of the most durable competitive advantages a business can possess. The incredible durability of businesses like American Express, Visa, and MasterCard can be explained by a powerful psychological phenomenon known as the network effect, often supercharged by what Charlie Munger calls the Lollapalooza effect. The basic principle of a network effect was first described by Robert Metcalfe. Metcalfe's law states that the value of a communications network is proportional to the square of the number of connected users. A single telephone is useless. Two telephones create one connection, giving the network some value. 100 telephones create nearly 5,000 potential connections. 1,000,000 telephones create nearly 500 billion connections. The value of the network doesn't grow linearly, it grows exponentially. This is the secret sauce of all digital toll booths. Consider the Visa network. Its value is not in its computers or its brand name alone. Its value comes from the two sides of its network, the billions of cardholders worldwide, and the tens of millions of merchants who accept the card. Every time a new person gets a Visa card, the network becomes slightly more valuable to every single merchant. And every time a new merchant puts a Visa sticker in their window, the network becomes slightly more valuable to every single cardholder. This creates a powerful, self-reinforcing feedback loop. It's a chicken and egg problem that, once solved, creates an almost impenetrable moat. A new competitor would have to somehow convince billions of people to carry a card that no one accepts, and convince millions of merchants to install a terminal that no one uses. It's a nearly impossible task. This is then amplified by the Lollapalooza effect, a term Munger uses to describe a situation where multiple cognitive biases act in the same direction to produce an extreme outcome. In the case of a payment network, you have social proof. Everyone else uses Visa, so it must be good. Commitment and consistency bias. I've been using this card for years, it's just what I do. And status quo bias. Switching my automatic payments and learning a new system is a huge hassle. All of these psychological forces work together to lock users into the existing network, making the competitive advantage of the incumbent almost absolute. It's no longer just a business, it's the standard. It's the financial equivalent of the QWERTY keyboard, deeply entrenched, universally accepted, and a nightmare to even think about replacing. This combination of an exponential value proposition and a convergence of psychological biases is what transforms a simple service into a digital fortress, a toll booth that sits astride the river of global commerce. How can we as investors systematically identify these powerful digital moats? We can use a mental model called the two-sided market mapper. This is a blueprint for analyzing businesses that, at their core, act as intermediaries or platforms. It has 4 steps. The first step is to clearly identify the two sides of the market. You must ask, who are the two distinct groups of users this business brings together, and what value do they provide to each other? For Visa, it's cardholders and merchants. For a stock exchange, it's buyers and sellers of securities. For a credit rating agency like Moody's, it's bond issuers who need a rating, and investors who need to assess risk. Clearly defining these two sides is the foundational step. If a business doesn't have at least 2 distinct user groups that value access to each other, it's not a two-sided market. The second step is to analyze how the business solved the initial chicken and egg problem. This is the hardest part of building a network. How did it attract the first users when the other side of the network was empty? Did it subsidize one side, perhaps by giving away the service for free to consumers to build a user base it could then sell to businesses? Understanding the origin story of the network gives you insight into its core strategy and potential vulnerabilities. The third and most critical step is to measure the switching costs for time sides of the network. This is where most amateur analysis falls short. It's not enough for one side to be locked in. Both must face significant friction to leave. For a consumer, switching credit cards is a moderate hassle. But for a merchant, the cost of not accepting Visa is catastrophic. It means turning away a huge percentage of potential customers. The switching cost is immense. For a company that has had its bonds rated by Moody's for decades, switching to a new, unproven rating agency would be highly risky and could result in paying higher interest rates. The switching costs are high on both sides. High switching costs for both user groups are the hallmark of a true, durable digital toll bridge. The final step is to map the value flow. How does the business capture a small piece of the immense value that it facilitates between the two sides? Visa and MasterCard take a tiny percentage of each transaction, known as an interchange fee. A stock exchange takes a minuscule fee on each trade. This take-rate model is incredibly powerful. The business doesn't have to sell a big expensive product. It just sits in the middle of a massive river of commerce and dips a small cup in, over and over, billions of times a day. By applying this four-step mapping process, you can move beyond simply identifying popular platform businesses and start to understand the deep underlying structure that gives them their economic power. The path of the 99% is littered with the wreckage of investors who mistook a popular product for a powerful network. The antithesis of investing in a true digital toll booth like Visa is investing in a platform business with no real sustainable network effect. This is a subtle but disastrously important distinction. Many businesses can attract a large number of users, but they fail to build the structural lock-in that creates a durable moat. The history of social media provides a perfect graveyard of examples. Think of MySpace. In the mid-2000s, it was the undisputed king of social networking, with hundreds of millions of users. It seemed like an unassailable digital toll bridge for social connection. But its network effect was shallow. The value came from your friends being on the platform, but the cost of switching was incredibly low. When Facebook came along with a cleaner interface and a more compelling product, users began to leave. At first, it was a trickle. Then it became a flood. People could easily rebuild their social graph on the new platform. There was no deep integration into the commercial or professional lives of its users. There was no high-friction barrier to exit. The same story played out with platforms like Vine. It was wildly popular for a short period, but its user base was fickle, and the switching costs to move their attention to Instagram or TikTok were zero. The key mistake investors make is confusing temporary popularity with a permanent moat. They see massive user growth and assume a network effect is present, without ever analyzing the true switching costs. They fall in love with the story of the platform but fail to do the rigorous work of mapping the two-sided market and stress-testing the user lock-in. A true digital toll booth, like the Visa network, is not just popular. It is essential. It is woven into the very fabric of commerce. It would be nearly impossible for the modern economy to function without it. A fleetingly popular app, on the other hand, is a fad. It is a party that is crowded today but could be empty tomorrow. Learning to tell the difference is a crucial skill for anyone focused on long-term investing and the preservation of capital. The 99% chase the party. The successful investor buys the venue. This fundamental difference in business models is reflected directly in the financial statements through the concepts of take rate and operating leverage. A digital toll bridge like Visa or MasterCard operates on a fascinating financial model. Their take rate, the percentage they keep from the total volume of transactions flowing through their network, is minuscule, often less than 1%. They are not charging a large, obvious fee. They are taking a tiny slice of a gargantuan pie. In 2023, Visa processed over $17 trillion in total payments volume. Even a tiny sliver of such an astronomical number translates into tens of billions of dollars in high-margin revenue. This model is psychologically brilliant, as the fee is nearly invisible to the end consumer, yet it scales to an unbelievable degree. This scaling is where the magic of operating leverage comes in. Operating leverage refers to the relationship between a company's fixed costs and its profitability. A business with high fixed costs, like the digital infrastructure of a payment network, and low variable costs, the cost of processing one more transaction is virtually zero, has high operating leverage. This means that once revenue grows enough to cover the fixed costs, each additional dollar of revenue falls almost entirely to the bottom line as pure profit. Imagine the Visa network, whether it processes $10 trillion a year or $11 trillion a year. The cost of maintaining its global network of servers and software remains relatively stable. But that extra $1 trillion in volume generates billions in new, high-margin revenue. As revenue grows, profits grow much, much faster. This is the financial engine of a great digital toll bridge. It is a business model of incredible elegance and power. It contrasts sharply with a business that lacks this leverage. A consulting firm, for example, has low operating leverage. To double its revenue, it generally needs to double its number of consultants, and therefore double its salary costs. Its profits grow linearly with its revenues. The digital toll booth's profits grow exponentially. This is the kind of explosive, scalable profitability that makes these companies such phenomenal long-term investments and a cornerstone of any blue-chip investing strategy. Even with a deep understanding of what a toll bridge looks like, both physical and digital, there is another, more insidious danger: the pretender. These are businesses that look and feel like toll bridges, often for many years, but contain a hidden fragility, a vulnerability to disruption that can wipe out investors who fail to spot it. Identifying these fake toll bridges is one of the most difficult but essential skills in value investing. There is no better cautionary tale than Warren Buffett's own experience with IBM. For decades, Buffett famously avoided technology stocks, stating that he operated within his circle of competence and simply didn't understand how to evaluate their long-term competitive advantages. IBM, for a long time, was the bluest of blue-chip stocks. It dominated the world of mainframe computing for large corporations. It had a massive sales force, deep customer relationships, and high switching costs. For a large bank or insurance company in the 1970s or 80s, ripping out their IBM mainframe and replacing it with a competitor's system was an unthinkable risk. IBM looked like the ultimate technology toll bridge. In 2011, Buffett reversed his long-held stance and invested over $10 billion in IBM. He believed that the company's position in corporate IT departments was so entrenched that it constituted a durable moat. He had spoken to countless chief information officers who felt locked into the IBM ecosystem. However, he misjudged the nature and speed of the technological shift that was already underway. The rise of cloud computing, led by companies like Amazon Web Services, was fundamentally changing the game. Companies no longer needed to buy and maintain their own massive, expensive mainframes. They could rent computing power from the cloud, paying only for what they used. This new model offered more flexibility, lower costs, and faster innovation. It was a substitute that fulfilled the same customer need, corporate computing, but in a better, cheaper, and more efficient way. The moat that Buffett thought was a castle of stone turned out to be a sandcastle against the rising tide of the cloud. Over the next several years, IBM's revenues stagnated and then began to decline. The stock went nowhere. In 2018, Buffett admitted his mistake and sold the entire position, likely at a loss. This story is a powerful lesson. Even the greatest investor of all time can misidentify a moat, especially when that moat is based on a specific technology rather than a permanent structural advantage. It highlights the critical importance of not just identifying a moat, but constantly questioning its durability in the face of a changing world. The mistake of investing in a seemingly dominant company that is on the verge of being disrupted is often driven by two powerful cognitive biases: the availability heuristic and extrapolation bias. The availability heuristic is a mental shortcut where we judge the likelihood of an event based on how easily examples come to mind. When a company has been dominant for decades, like Kodak in film photography, Nokia in cell phones, or Blockbuster in video rentals, its success is highly available in our collective consciousness. We have seen their products everywhere for our entire lives. They are market leaders. They are household names. This mental availability creates an aura of invincibility. We find it difficult to imagine a world without them, because our brains are saturated with evidence of their past and present success. This leads directly to the second and even more dangerous bias: extrapolation bias. This is our natural tendency to assume that recent trends will continue indefinitely into the future. If a company has been growing its earnings by 10% a year for the last decade, our brains instinctively project that same growth rate forward. We take the readily available information about its past dominance and draw a straight line into the future. This is a catastrophic mental error. It completely ignores the possibility of paradigm shifts, of disruptive innovations that can render an entire business model obsolete in a few short years. The investor who bought Kodak stock in the late 1990s was a victim of these biases. Kodak's dominance of the film industry was absolute. Its brand was iconic. Its past performance was stellar. The investor, using the availability heuristic, saw an invincible giant. Using extrapolation bias, they projected decades more of healthy profits from selling film and chemicals. What they failed to see was the tiny, nascent technology of digital photography, which at the time was a niche, expensive product with poor quality. They ignored the substitute that was on the horizon because it didn't fit their mental model of the world. They were looking in the rearview mirror of past success instead of looking through the windshield at the road ahead. This combination of biases, overweighing the easily remembered past and projecting it into a linear future, is the psychological trap that turns former blue-chip stocks into permanent capital losses. It is the mental fog that prevents investors from seeing that the toll bridge they thought was made of granite is about to be washed away. To avoid this fate, we need a systematic way to probe for weaknesses. We need a mental model designed to find the cracks in the foundation of a seemingly strong business. Let's call it the moat erosion stress test. This framework consists of 4 critical questions you must ask about any business you believe to have a durable moat. The first question targets the threat of substitution. What new technology or business model could fulfill the same underlying customer need, but in a cheaper, faster, or better way? Don't just look at direct competitors. Look for indirect substitutes. The enemy of the railroad wasn't a better railroad. It was the interstate highway system and the trucking industry. The enemy of the newspaper wasn't a better newspaper. It was the internet, which delivered information faster and for free. You must think like a disruptor and ruthlessly attack your own investment thesis. The second question addresses regulatory risk. Could a change in government regulation completely dismantle this company's competitive advantage? Many moats are granted or protected by the government. A drug patent, a cable television franchise, or a legally mandated utility monopoly. These can be incredibly powerful, but they are also vulnerable to a shift in the political winds. A government could decide to break up a company it deems a monopoly, or introduce new regulations that invite competition. You must assess how much of the company's moat is a result of genuine business excellence versus government favor. The third question is about customer concentration risk. Does a single customer or a small group of customers account for a huge percentage of the company's revenue? A business might look like it has a strong position, but if half of its sales are to one big client, like Walmart or the U.S. government, it's not a toll bridge, it's a vassal. The power dynamic is completely skewed, that one customer can dictate prices and terms, squeezing all the profit out of the supplier. The loss of that single customer could be a fatal blow. A true toll bridge serves a wide, diverse customer base where no single user has significant power. The final question is what I call the reverse toll test. Is the company's product so expensive or so painful to use that customers are actively and desperately seeking an alternative? This is a sign of a fragile moat. For years, people hated their cable companies. The bills were high, the service was poor, and the bundles were filled with channels they didn't want. They were trapped. But the moment a viable substitute appeared in the form of streaming services, customers fled in droves. They were not loyal, they were hostages. A business that angers its customers is creating a massive incentive for an innovator to come and solve that pain. A truly great toll bridge is one that customers use not because they have to, but because it provides a good service at a fair price. By stress testing your investment ideas with these 4 questions, you can begin to distinguish between the truly durable businesses and the pretenders who are living on borrowed time. The path of the 99% in this area is to get swept up in the story stock phenomenon. This is the opposite of performing a rigorous moat erosion stress test. A story stock is a company, often in the technology or biotech space, that has a compelling narrative about how it will change the world. The story might be about a revolutionary new drug, a paradigm-shifting artificial intelligence, or a new form of clean energy. The narrative is exciting, futuristic, and easy to fall in love with. Investors buy the story, not the business. They focus on the potential size of the market and the brilliance of the technology, but they spend little to no time analyzing the competitive landscape or the durability of any potential moat. They confuse a cool product with a great business. A cool product can be copied. A great business has a structure that prevents it from being copied. The hype around many disruptive companies of the past decade falls into this category. Investors poured money into companies with a great story but no clear path to sustainable profitability and no identifiable, defensible competitive advantage. They were betting that the company could grow fast enough to build a moat later. This is a dangerous and often fatal investment strategy. It's like building a beautiful castle in the middle of an open field and hoping to dig a moat before the invaders arrive. More often than not, the competition arrives first. The successful toll bridge investor does the opposite. They look for the company that already has a deep, wide, crocodile-infested moat. The story might be boring: a railroad, an insurance company, a credit rating agency, but the business model is beautiful in its resilience and profitability. The 99% chase exciting stories and end up with permanent capital loss. The intelligent investor focuses on boring but durable business structures and ends up with a lifetime of compounding wealth. This distinction is the very essence of value investing. The financial clues that distinguish a true toll bridge from a pretender facing erosion can often be found by analyzing revenue trajectories and research and development, or R&D, spending as a percentage of sales. A genuine toll bridge with a stable moat and pricing power should exhibit a remarkably smooth and predictable upward trending revenue line. Year after year, it grows at a steady pace, driven by price increases and the slow, stable growth of the economy it serves. There are no wild swings, no terrifying plunges. Its revenue chart is a picture of serene, almost boring consistency. A pretender, on the other hand, a company whose moat is under attack from a new technology or competitor, will see its revenue trajectory begin to flatten, become erratic, and eventually decline. This is the first financial signal that the competitive advantage is eroding. The market may not have noticed yet, the stock price might still be high, but the numbers are whispering a warning. The second, more subtle clue is in the R&D budget. A true toll bridge, particularly one based on a structural advantage like a railroad or a brand, often has surprisingly low R&D needs relative to its size. BNSF doesn't need a massive lab to reinvent the concept of a train. Moody's doesn't need to spend billions developing a new way to rate bonds. Their moat is not dependent on a constant stream of technological innovation. In contrast, a technology company whose moat is based on having the best product at any given moment is trapped on a treadmill of innovation. It must spend a huge percentage of its sales on R&D just to keep up with its rivals. If it ever slows down, it will be overtaken and become obsolete. This high R&D spending is a tax on the business. It eats into profits and reveals that the company's competitive position is not a permanent fortress, but a temporary hill that must be furiously defended every single day. When you see a company with stable or growing revenues combined with low and manageable R&D spending, you may be looking at the financial footprint of a true, durable toll bridge. When you see a company with flattening revenues and a ballooning R&D budget, you are likely looking at a pretender fighting a losing battle against the forces of creative destruction. We have now defined the toll bridge, studied its physical and digital forms, and learned how to spot the dangerous pretenders. The final step is to synthesize this knowledge into a coherent, actionable plan. We need a practical guide to building our own financial fortress, a portfolio composed of these incredible businesses. To begin, we must look at what Warren Buffett considers his dream business, a perfect microcosm of the toll bridge principle, not in infrastructure or technology, but in a simple box of chocolates, See's Candies. Berkshire Hathaway acquired See's Candies in 1972. At the time, Buffett was still mostly focused on buying statistically cheap cigar butt companies. See's was different. It wasn't incredibly cheap. It was a high-quality business, and his partner, Charlie Munger, had to convince him to pay a premium price of $25 million for it. It was one of the most important decisions they ever made, as it shifted their focus from buying fair companies at wonderful prices to buying wonderful companies at fair prices. On the surface, See's just sells candy. There are no patents, no government licenses, no physical monopoly. And yet, it functions as one of the most powerful toll bridges imaginable. Its moat is not physical, it is psychological. It is built in the minds of its customers. See's has been a California institution for over a century. For generations, people have given See's candies as gifts, for Valentine's Day, for Christmas, for birthdays, for apologies. The brand is inextricably linked with powerful positive emotions: love, celebration, family, and tradition. When a customer buys a box of See's, they are not just buying chocolate. They are buying certainty. They know the quality will be high, the taste will be familiar, and the recipient will be happy. This powerful brand association gives See's incredible pricing power. As Buffett has explained, they can raise their prices every single year, and almost no one defects to a cheaper competitor. A man taking a box of chocolates to his new girlfriend on their first Valentine's Day is not going to risk saving $1 or $2 on an unknown brand. He is going to buy the trusted premium option. He will pay the toll to ensure a successful outcome. See's Candies requires very little new capital investment to grow. It produces a flood of free cash flow that Berkshire has been able to use to buy other businesses for decades. It is the perfect example of a toll bridge built on an intangible asset, a brand that owns a small but valuable piece of real estate in the customer's brain. It teaches us that a moat can be built from trust and habit just as effectively as it can be from steel and concrete. The incredible pricing power of a brand like See's Candies is a direct result of two deep-seated psychological principles: the endowment effect and brand loyalty. The endowment effect is a cognitive bias identified by behavioral economists, which shows that people place a significantly higher value on something simply because they own it or feel a connection to it. See's Candies has brilliantly endowed its customers with a lifetime of positive memories and experiences. The brand doesn't just own its stores and factories. In a very real sense, it owns a piece of its customers' personal histories. Christmas morning, a first date, a Mother's Day celebration. These experiences are now intertwined with the black and white See's packaging. When a customer thinks about See's, they are not just evaluating a product. They are tapping into their own cherished memories. This emotional endowment makes the product far more valuable in their mind than its physical ingredients would suggest. They are not just buying sugar and cocoa, they are repurchasing a piece of their own past. This is then cemented by brand loyalty, which is really just another name for the commitment and consistency bias. We have a deep-seated need to be consistent with our past decisions and behaviors. If you have been buying See's Candies for your spouse every anniversary for 20 years, the decision to do so again this year is almost automatic. It's the default choice. To switch to a different brand would require cognitive effort and would feel like a break in a cherished tradition. It would create a feeling of inconsistency that our brains are wired to avoid. This powerful combination of emotional endowment and the drive for consistency creates a fiercely loyal customer base that is highly insensitive to price. They are not making a rational, calculated decision based on a spreadsheet of price versus quality. They are making a largely emotional and habitual decision. This is the psychological mechanism behind a great consumer brand. It builds a toll bridge over the river of human emotion and tradition, and once established, it is a river that flows with predictable, profitable regularity. So how do we put all of this together? How do we go from theory to action? The answer is a systematic process we can call the Toll Bridge Portfolio Construction Protocol. This is a 5-step blueprint for building a portfolio of durable, high-quality businesses for long-term wealth building. Step 1 is screening. The world has thousands of publicly traded companies. We need a way to filter them down to a manageable list of potential candidates. You can use a financial data service or a stock screener to search for companies with the financial footprints of a toll bridge. You would screen for metrics like consistently high gross margins, over 40% for example, a history of stable and predictable revenue growth, a high return on tangible capital, and a low level of debt. This initial screen will eliminate the vast majority of mediocre and speculative businesses and leave you with a hunting ground of potentially high-quality companies. Step 2 is qualitative analysis. This is where you take the list from your screen and do the real intellectual work. For each company, you must apply the mental models we've discussed. You will run it through the 5 questions of indispensability. You will apply the permanent asset litmus test if it's an infrastructure business, or the two-sided market mapper if it's a network business. And most importantly, you will ruthlessly attack it with the moat erosion stress test. This is the research-intensive phase where you read annual reports, study the industry, and think deeply about the durability of the company's competitive advantage. Step 3 is valuation. Identifying a wonderful business is only half the battle. You must also buy it at a fair price. As Buffett says, the price you pay determines your rate of return. This does not mean trying to time the market. It means being patient. You will have a watch list of wonderful toll bridge businesses you have identified, and you will wait for what he calls a fat pitch. This could be a general market downturn that drags all stocks down, or a company-specific problem that scares away other investors, like the Amex salad oil scandal. When a great business goes on sale due to temporary fear or uncertainty, you act decisively. Step 4 is position sizing and diversification. The toll bridge approach is not about owning hundreds of different stocks. That's a strategy for ensuring average results. Instead, it is a strategy of calculated concentration. You should aim to build a portfolio of your 10 to 15 best ideas, the companies you understand the most, and in which you have the highest conviction. This forces you to be highly selective and ensures that your best ideas can have a meaningful impact on your overall returns. Step 5 is the final check, the Rip Van Winkle test. Once you have bought a stock, imagine you are going to fall asleep for 10 years like the famous character. When you wake up, would you feel comfortable and confident about the prospects of the business you own? This question forces you to tune out the short-term noise of the market and focus exclusively on the long-term durability of the business itself. If you can't confidently say yes, you haven't found a true toll bridge. This 5-step protocol transforms investing from a speculative guessing game into a disciplined, business-like process for achieving financial freedom. To fully commit to this disciplined path, you must consciously reject the chaotic and destructive approach that dominates the thinking of the 99%. The antithesis of patient, long-term toll bridge investing is the world of day trading, market timing, and what Buffett derisively calls diversification. The average market participant is frenetic. They are glued to the financial news, reacting emotionally to every headline, every Federal Reserve announcement, every analyst upgrade or downgrade. They buy a stock because it's going up and sell it in a panic because it's going down. Their decisions are driven by greed and fear, not by business analysis. They are trying to predict the unpredictable, the short-term movements of the stock market and the economy. This is a loser's game, a form of high-stakes gambling disguised as a sophisticated strategy. Then there is the folly of excessive diversification. Financial advisors often tell people to own a little bit of everything, hundreds or even thousands of different stocks through mutual funds and ETFs. While this protects you from the catastrophic failure of a single company, it also guarantees that you will achieve at best mediocre, average market returns before fees. It is an admission that you don't know how to distinguish a great business from a poor one, so you buy them all. Charlie Munger has said that this know-nothing approach to diversification is fine for someone who doesn't want to do the work, but for those who are willing to put in the effort to understand businesses, a more concentrated portfolio of superior companies is far more logical. The toll bridge approach is the ultimate rejection of this frantic, unfocused activity. It is a philosophy of minimalism and concentration. You do a massive amount of work up front to identify a small number of truly exceptional businesses. You buy them at a fair price. And then, you do the hardest thing of all, nothing. You let the power of compounding work its magic over years and decades. It is a strategy of patience, of discipline, and of thinking like a business owner, not a gambler. It is the path less traveled, but it is the one that leads to the destination of true, lasting wealth. Ultimately, the power of this entire approach is demonstrated by its direct financial connection to superior long-term results, which can be measured through shareholder yield and the compounded annual growth rate, or CAGR. A great toll bridge business, with its abundant free cash flow, has multiple ways to reward its owners. The most obvious is through a growing stream of dividends. This is the most direct form of passive income. But it's only part of the story. These companies often engage in aggressive share buybacks. When a company buys back its own stock, it reduces the number of shares outstanding. This automatically increases your percentage ownership of the business and your claim on its future earnings. A metric called shareholder yield combines a company's dividend yield with its buyback yield, the percentage of its market cap it spends on buybacks. High-quality toll bridge businesses often have a very attractive shareholder yield, demonstrating a clear commitment to returning capital to their owners. But the true magic is revealed over the long term, through the power of compounding. Let's imagine 3 hypothetical portfolios over a 20-year period. Portfolio A is the story stock portfolio, chasing exciting but unprofitable companies. It likely ends up with a negative return, a complete loss of capital. Portfolio B is the S&P 500 index fund, the know-nothing approach. It would have done reasonably well, perhaps achieving a CAGR of 7 or 8%. But Portfolio C, a concentrated portfolio of carefully selected toll bridge businesses bought at fair prices, would have almost certainly done much better. Its CAGR might be in the range of 12 to 15%, or even higher. The difference between compounding at 8% and compounding at 13% over 20 years is not small. It is the difference between a comfortable retirement and true financial freedom. It is the tangible, life-changing result of choosing to own the indispensable, of building your financial future on a bedrock of durable, resilient, and profitable economic toll bridges. You have just spent this time acquiring a powerful and timeless mental model. You now possess the framework for identifying toll bridge businesses, the rare and wonderful companies that own a piece of the world's essential infrastructure, granting them a durable, competitive advantage that can compound wealth for generations. You've moved beyond the noise and speculation that occupies the minds of most market participants, and have grasped a fundamental principle of sound, long-term investing. This is an enormous step, but it is crucial to understand that this is one part of a much larger, interconnected system of thought. Identifying a great business, the what, is the first pillar, but the complete structure of a successful investment philosophy rests on other pillars as well. Knowing when to buy that great business and how to hold it through the storms of market volatility requires a completely different set of mental tools. The world is full of people who can recognize a quality company, but they overpay for it, destroying their returns. Or they correctly identify and buy a great business at a fair price, only to be shaken out in a panic at the first sign of trouble. The video that is now on your screen is designed to build that next pillar. It addresses the critical link that connects the identification of a wonderful company to the successful execution of a wonderful investment. It is the next piece of the map. Most people will stop here, satisfied with the theory they have learned. But the journey from knowledge to wisdom, from being a student of the market to a master of your own financial destiny, requires a commitment to building a complete mental arsenal. The decision to click is not about watching another video. It is a declaration that you are serious about this journey. It is the choice to move from understanding the core bade, what, to mastering the bade, how, and the do of when. Complete your education, fortify your mind, continue your ascent.